Hi guys, imagine waking up to see your stock investment fell by 40% and that too within just 5 days. Well, that's exactly what happened with Gensol Engineering Limited. Why did that happen? We are here to find it out. First of all, I welcome you all to my channel BYOP, that is Build Your Own Portfolio. Alright, and in today's video, we will cover an article that was posted by FinShots. The article name is The Curious Case of Gensol Engineering. I really like this article and there are very interesting key takeaways that we can learn from this article and use in our financial journey. All right, so let's get right into it. I have prepared a nice presentation out of this whole article, The Curious Case of Gensol Engineering. And by the way, this name is a reference from movie The Curious Case of Benjamin Button that you can see. It's a really interesting movie. Let's first talk about the rise of the Gensol. See, the Gensol wasn't always in trouble. All right. First, it went public in the year 2019 as an SME IPO, and it quickly became an eye-catching investment for all the investors. Now, why did that happen? Because it operates in two very interesting sectors or the hot sectors that are renewable energy and EV mobility. All right. Now, the stock price was booming, profits were growing, and they had massive expansion plans. Now, because of all this, it soon got listed in NSE and BSE main markets in 2023. Now, the question is, what went wrong that price started falling so much? All right. Now, that brings me to the first red flag, that is credit rating. All right. Now, what is credit rating? To give you the context, there are two major credit rating firms that are ICRA and CARE. All right. So what do? They analyze the companies and they give a credit rating score or a rating to the company. All right. So in case of Gensol, they downgraded Gensol's credit rating from BBB negative to D. All right. I have attached the credit rating uh, points over here. You can say it to understand it in an easier manner. You can think of it as a school's report card, but it is for companies. All right, where AAA is the highest quality, very low risk, that means top student. All right, and D is a failing student who has defaulted and there is no chance of repayment. All right, and in case of Gensol, from here BBB to it got downgraded to D. All right, why now? Why did that happen? Why credit rating companies downgraded this company? It is because of the loans, which brings me to the next slide, that is the real problem, debt and cash flow issues. All right. Now, Gensol has loans of 1372 crores while they have reserves of only 589 crores. All right. Now, that's a debt to equity ratio of more than 2. All right. In simple words, they owe way more than they can afford. Okay. So, always remember ideal debt to equity ratio. In all of my videos, I have been saying this. Do check the debt to equity ratio. It should be either 1 or less than 1. It should not be more than 1 in any case, right? Now, the thing is, now the another interesting thing is, Gensol claimed that they were making their payments, loan repayments on a timely basis, but credit rating agencies didn't buy it. This started a war of questions where, like, if a company is hiding, if a company can hide finances, then there is no transparency, which leads to the banks losing their trust in such companies and they may not get any loans, right? Well, huge loans and very few reserves is not the only problem. Let me give you another shocking fact, that is, promoters have pledged 82% of their shares to get these loans. Now, pledging of shares is fine, but too much pledging is not good. Moreover, when stock crashes, even banks starts panicking. They demand more shares. They even sell the existing shares. Now, all of this drives the stock price down even further. Well, that's exactly what happened with Gensol. They have too much loan, that too by pledging their own shares. All right. And on top of that, credit rating companies have downgraded their rating, and that's why we can see the stock price has fallen. All right. Now let's discuss some key takeaways for the investors like you and me. All right. So first and the foremost thing is always check debt levels. Okay. I have been saying in all my videos that please make sure to check debt to equity ratio. It should be less than 1 or 1, not more than that. Okay. Now, second key takeaway, check for credit rating reports. Where can we check this? The answer again is screener. Third, monitor promoter pledging. How can we check how much shares are pledged by the promoter? Again, the answer is Screener website. I'll take you to the website and I'll show you all of these things. Fourth, and the most important point, whenever you see a news stating that so and so company has acquired this much of order from uh, so and so clients, don't just go and blindly invest in that particular stock. Always and always check if how those orders are turning out for the companies. Are they even making profit or not? All right, let me quickly take you to the screener website to see where can we check all of this information. All right, so the first thing is debt to equity ratio for this company, Gensol Engineering Limited company. It is 2.33, which is very high. It should be less than 1. All right, so from here we can check debt to equity ratio. If you need to check the how much pledging of shares is there, promoters have pledged 81% of their holding. So pledging of shares is not considered a good thing. That's why it is mentioned in the con list. All right. Third thing, where can we check the borrowings or the debt or the loans of the company? Here you can see 1372 crores uh, are mentioned under borrowings, and they only have reserves of 551 crores. All right. Now going further down, you can see the credit ratings over here. See, on 4th of March from ICRA and 3rd of March from CARE, these both agencies have published the credit rating reports. You can simply click on it and it will load the entire report where the companies will even give the entire rationale why they have given such rating to the company. All right, and they tell everything, what is looking good, what is looking bad, and accordingly they give a rating to the company. So these were the key takeaways from this article. Now what's next for Gensol? Now in order to recover, it must prove that it can repay debts consistently. It needs to show actual profits, not just the order books. Okay. And the third and the most important thing is promoters should reduce pledging or buy shares to rebuild the trust. Now, if you like this video, if you learned something new from this video, please give me a like, share this video, and do subscribe. Thank you so much.